And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA Corporate and Investment Banking, proud host of the Beyond the Budget 2025 event, themed around reimagining inclusive and sustainable economic growth. Good evening. Welcome to The Money Show tonight. I'm Stephen Grootes. We'll speak to the CEO of Impala Platinum in just a few moments. Quite a lot of corporate news out today in all sorts of different ways, some of it around SPA, some of it around Motus. You'll hear their CEO. Something that's almost possible to miss is that there seems to be a new CEO of South African Airways, John Lamola, being confirmed by Cabinet. It appears, from what I can see, that actually the decision was, in the end, taken by the Transport Minister, Barbara Tracey, after a meeting both with President Cyril Ramaphosa and then also with the Deputy President, Paul Mashatile. And if you remember how the ANC works, the Deputy President's often been chair and is usually chair of the Deployment Committee. And I raise that because this was the subject of some litigation. You recall, of course, the whole idea was that the records of ANC deployment meetings were supposed to be made public. I don't think there were in their entirety, but the Zondo Commission did say that cadre deployment was unconstitutional. At the same time, there's so many things that come out of this. So, for example, there was a man called Alan Kulavuka who, from what we understand, was actually rated by the board as the best candidate. But he is not South African. And Tracey says that is why they've picked John Lamola. He is the interim CEO, so you could make an argument there. And there are different headlines, and we're due to hear from John Lamola himself in the next week or so on The Money Show. And I'm looking forward to that conversation. I mean, can't be great to have headlines saying he was the worst candidate. Well, the worst out of three. Okay, so let's have a little bit of perspective. And on the one side, I just want to say the idea of saying that someone who's the best candidate we can't use because they're, a foreigner, I don't know, that sounds a little bit parochial. It sounds a little bit small. I mean, Bafana at the moment being coached by a foreigner, doing better than they have in quite some time, thank you very much. I know South African rugby has never done it. On the other hand, no one is as good as Rassie Erasmus, so the problem immediately falls away. And I can also remember if someone were to say, well, we should look abroad, we should look for a foreign CEO at SAA. Coleman Andrews, do you remember that? That was a bit of a disaster, cost a fortune in the end. He was a foreign national, came here, lots of experience, etc., and it didn't end well. So the arguments go in lots of different ways. I do think whoever is going to run SAA needs to, and let's just call it what it is, they need to take on the sort of Checkers 60, if you like, of the airline industry, which is Fly Safair. And I say that because both Checkers 60 and Fly Safair came out of the pandemic much stronger than they went into it. And we're dealing with a different set of variables now. And I think that is really the task. You have to deal with that. And we should call it what it is. And you can't do that if you're going to run yourself like a government airline like SAA used to. You have to do something very different. A lot of rain again in Gauteng today. And of course, this has been last week. I mean, there were all of those memes. Gauteng is drowning. It's not waving. Help. But it does mean that it seems that our maize production is now expected to be up quite dramatically, about 8%. And so that really does tell you the impact of the rain. And then also interesting to talk about cars, and we'll speak to the Motus CEO in a while. What car would you realistically want to buy? I don't mean, what sports car do you want or what bakkie do you want? I mean, which car realistically are you looking at and why? And it goes to, do you need a bakkie? Are you the sort of mover in the family? Are you running a small business? You need to shift stuff around. Do you, just like to go fast? Do you actually need something reliable? Do you need something that you could maybe pass on to a younger driver in a couple of years' time? And that really gets you to the heart of it. So I'd be interested to hear from you, please, on what car you realistically want to buy. 011 883 0702 021 446 0567. Voice notes tonight on 072 702 1702.
702.
702.
Stephen is on The Money Show.
6 to 8 p.m.
A warning today from Impala Platinum. It's still under pressure because of the weak platinum group metals prices in rand terms. The company also saying, while it has already taken decisive action, it will continue to develop its response. Implat's revenues down 3% for the first 6 months to the end of December, was still able to deliver a gross profit, though. The CEO of Impala, the group executive for corporate affairs at Impala, is Johan Theron. Johan, good evening to you, and thanks for your time. You're running a platinum mining group in very tough times. You've described the demand outlook for PGM as anemic. Is there any light on the horizon at all?
Good evening, Stephen. Yeah, indeed, tough times for the entire industry. But in the end, we can only control what we can control. And for us, that's volumes and costs. And as you mentioned, I think we've done a sterling job in the last 6 months. And we've generated free cash, So for the times in which we are, not a bad outcome.
We heard from a colleague of yours from a different platinum group last week. He told us that at the moment, there's very little investment in new platinum mines anywhere. His point is that when the asset turns, and when the cycle turns, and he's quite confident that it will, he will still control the assets that he does. Do you share that view? At some point, the cycle will turn, you will still have working platinum mines, and no one's doing any platinum prospecting at the moment.
Yeah, no, absolutely. I think one has to recognize that the majority of platinum still being mined in Southern Africa is from the Rustenburg area. Those mines have been in operation for 60-odd years and coming to the end of their life. And indeed, there hasn't been investment because the industry did have a decade of very low profitability. And as we were coming out of that, we first had to restore balance sheets and infrastructure. And with electrification and the long-term prospects, still be questionable, it's a brave board that invests multi-billion rands in, decade projects. So, these operating high-quality assets will certainly come to their fore again.
You said in your statement this morning you're still developing your response. I mean, does that mean there could be more restructuring? It sounded to me like it did mean that.
Yes, indeed. I think we've taken decisive action. We've reduced our workforce by about 5%, 3,000-odd jobs. Fortunately, no forced retrenchments. We were able to navigate with the unions through that, through voluntary separation and not filling vacancies. But, the good thing is most of our mines was profitable and generated free cash. Not sterlingly so. There was one operation on the eastern limb, Marula, where we did have some cash losses and where we're trying to effect a turnaround strategy. But during these downturns, you got to run faster and faster all the time to keep your head above water. And indeed, that's what we will do.
You are continuing with some investments. I mean, you make the point about multi-billion rand or multi-billion dollar investments, sure, but there are some other things you have to do in the meantime. Furnace 3 at Rustenburg, that's being rebuilt. You're expanding capacity at Zimplats in Zimbabwe. You're also, if I recall your SENS announcement correctly, also still investing in sort of solar power installations in some places. Are you confident those are going to pay off in the longer term?
No, absolutely. I think if we look at where the world is going, and I think everybody's got a sense of power and power availability and the cost going up. So things like investing in, off-grid, green, renewable power, making sure that we've got the processing capacities with these power disruptions that can withstand more volatility. And then we have pivoted, more into Zimbabwe, where there's larger, shallower, better quality ore reserves left. So our organization has slowly increased production out of the Zimbabwean jurisdiction compared to Southern Africa.
Do you find a big difference in operating costs in Zimbabwe per ounce than you do in South Africa? I realize they're neighbors, very different societies right now, I suspect. Obviously, it also depends, I presume, mine by mine. They have different things, but South Africa has quite deep mines.
I think that's the big differentiator, is that our mines are now quite deep. The ore bodies that we mine typically is about a meter, 1.2. So you got to get in there with manual mining methods, which takes a lot of people. It's also inherently more dangerous. In Zimbabwe, the mines are still new. They are shallow. They've been developed for mechanized equipment. The ore body is wider. So you're able to get in there with excavators and remove people from the physical mining phase. So there's a lot of advantages in that type of mining method.
Your production over the 6-month period was up 2%. Do you think you'll be able to continue with that momentum? I mean, do you expect your production to continue to increase slightly over the rest of the financial year?
Yes, indeed, that's the plan. And then we've also accumulated some in-process inventory over recent times where we were investing in furnaces and when we were having more difficult power situation in South Africa. So not only are we aiming to mine a little better, but also to rework some of that inventory and bring that into final metal so that we can sell and monetize that.
Johan Theron, thanks very much indeed. The Group Executive for Corporate Affairs at Impala Platinum.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
Well, the Crop Estimates Committee saying it now expects our farmers to produce around 8% more maize than they did in the previous season. It's the first summer forecast of the year. It's predicting a harvest of around 13.9 million tonnes. That's over 1 million tonnes more than last year. Paul Makube is the senior agricultural economist at FNB. Paul, good evening. Look, there's rain again in Gauteng today. I presume that rain is a big part of this, and the fact it's been so wet in so many parts of the country for so long over the last few months, that must be a big factor.
Definitely. Thanks. Good afternoon to your listeners. Definitely. We have, fortunately, a turnaround in production conditions in the country following a devastating 2023-2024, agricultural season. As you recall, the El Nino-induced drought that decimated crops last year. So there is a slight improvement in the production outlook. The recent rains have provided some reprieve after heavy, higher prices that we saw as a result of concerns whether we are going to have a crop this year or not.
It's not just that you plant what you planted last year, and if there's a lot of rain, you have a bigger harvest. You also need to plant. What I'm getting to is farmers now getting enough warning of how much to plant to take full advantage. And there were forecasts of a La Nina this year, and they were made quite some time ago. So I presume that farmers had a lot of warning.
Yes, the return of La Nina was already in the forecast from October already, September, October already. And although we had a wobbly start to the season with some areas, receiving delayed rains and delaying plantings, but overall the situation turned around. And January, late December, January, we saw, good rains coming in and into February, excellent February that we had already with more rain in most areas. And that resulted in farmers actually, planting, more this year.
The white maize goes to humans. It's sold for human consumption. Yellow maize usually goes to animals. If we have a big yellow maize harvest, does that down the food chain, have an impact on meat prices? As I understand it, maize has a sort of multiplier effect across food prices.
Yes, it has an impact on especially intensive livestock systems. The yellow maize. It is a major ingredient, about 70% of livestock feed is yellow maize, and therefore a reduction in production and also perhaps higher prices have an impact on the profitability of the livestock sector as a result of eroding margins during high prices. But if you look at the white maize, if you have an increase in white maize production, that there's always a possibility of use as well in the livestock sector. Although white maize is mainly used for maize consumption, for human consumption. There is during shortages of yellow that you have. White maize being also being added into the mix, but obviously that is relative to price. And as you are aware that for the first time we had imports, into South Africa of yellow maize, and if prices are relatively high and there is availability on the international market, we have that possibility of importing, as we saw in the previous season.
Okay, so I mean, it's tempting to see an estimate saying we'll have a big maize harvest, therefore maize should be cheaper, therefore other food prices might be cheaper. But obviously our prices are set by international markets, and the outlook there is what's really going to matter. So we should not expect sort of lower food prices or anything like that, and this may not have much of an impact on our food price inflation at all.
Oh yes, but I think the issue is monitoring what happens on the international market. We are over 60% exposed to developments on the international market, given the openness of our economy to world trade, and historically that has happened. And you also have the rand exchange rate playing a huge role in it. Whether prices reach import parity or they come down to export parity. A rand strengthening that provides a bit of a buffer in the sense that it actually pulls us closer to export parity. If it weakens, then it pulls us to import parity, which increases prices. At the current estimate. Of almost 14 million tons of maize being produced overall, is still still a small in historical terms. We normally in the past 5 years our average has been over 15 million tons of maize is being produced, but the 13 almost 14 million tons is still sufficient for our domestic needs as we work around 11.8 million tons of consumption for the domestic market.
Thank you very much indeed. Paul Makobe is Senior Agricultural Economist at FNB.
The Money Show.
The markets.
Graham Kerner at Corner Perspective joins us now. Graham, good evening. Motus down 15.77%. And I realise that their outlook for the automobile and the automotive industry, I should say, is not great. They're very honest about that. People are buying fewer new cars where they can. They're buying cheaper cars, etc. But it's still a massive decline on one day's trading of, something that was probably almost foreseeable.
Yeah, good evening, Stephen. I think it's quite strange, and sometimes you ask us to explain the behavior of others. And I must confess, we don't own Motus. We don't probably follow it quite as closely as we should. But I agree with you. When a company comes out with a mild decline in revenue and earnings basically flat, in fact, HEPS up slightly, the last thing you would expect to see is a 14-15% decline in the share price. But Stephen, I think part of the reason for that is, if I just compare it, if I may, with a big bank where there's, 8 PEs, dividend yields of 6-7%, arguably a fair amount of earnings momentum in it. So here you look at a business that is probably quite dependent on the consumer. I think there are other moving parts there, not least of which is the surge in Chinese and a couple of other brands, and that obviously hurts their import and distribution business. But yeah, it just feels to me as though the price action was excessive given the results that they delivered. But I do think that the reality is, if you think, the aftermarket parts is not a big revenue contributor, but it's a big profit contributor. And the slide in import and distribution market share, I think, is pointing to the fact that they may be selling less parts in the future. So I think what's also at play here is an anxiety around, what are the Chinese brands that have made such inroads into South Africa? What's the impact of them going to be on the import distribution business? And obviously a fair amount of that is sold through the Motus network. So I think the market might not be looking just at these results, but, taking this as a canary in the coal mine for, future demand for their range of products.
And Spar, down 7%. Now, look, they, like other supermarket chains are dealing with a sort of ShopRite phenomenon. But they have had consistent problems. Their turnover was also down, and that's obviously a very bad sign. It was down 1.6%. It's still 7% drop on the day.
Yeah, I think what you probably summarized it in one word, and that is ShopRite. When you when you look at how Shoprite has eaten the lunch of Pick n Pay and Spar and others, the reality is they're kind of not putting a foot wrong, and the others are scoring own goals, at the rate of a few every half. So I think for Spar, the reality is, even if there's relatively benign inflation, your comparable store sales or your comparable sales should be positive. And I think that's what's weighing on that. And then, of course, there's still, the issue around the European operations. I think they are committed, I think, by June to be out of those. But the reality is, they kind of lost their way somewhat. Probably, to be honest, neglected their core business, the South African business. And, there was a gap, and the likes of Shoprite, principally Shoprite, has taken that. So I think it's as much an indication of the anxiety the market's got with the SA model, but also I think the fact that it's a very, very brutally competitive landscape, and to claw back market share is going to be difficult because of the dominant position that Shoprite finds themselves in.
Overall, the JSE was down by over 1%, 1.13% on the day. And I kind of understand, if you look at the gold price and platinum price was down, that would obviously bring down resources, would bring down the index. We've spoken about two of the other big companies. Is there a sense of sort of, market weakness at the moment?
I think there's a nervousness, Stephen. That's the best way I can describe it. You call it the Trump factor, the Trump/Musk factor. It's just like a little bit binary right now. The market, I think, or markets globally, I think lack of conviction. I think a lot of us hoped that this was just sort of bluster and a negotiating tactic, but it looks as though, this tariff is going to meet some fairly stiff opposition, and that puts the cat amongst the pigeons from a market's point of view. So I think that the backdrop is one of anxiety. If I have to be honest, I think some weakness in some of the smaller caps that have maybe lagged a little bit. I think, you've got tax year in tomorrow, maybe a little bit of selling just to try and crystallize the odd capital loss to try and neutralize gains. I think at the margin, that's probably been adding to it. But I think, the overall mood in the markets globally is skittish, if I could describe it that way. And the only index that was actually up today was the SA property index on the local market, and that was 0.4%. But the rest of them, some pretty hectic falls along the financials and the banks, and even the resources down almost 2%. So the best way I can describe it is it's very skittish, in spite of very good value in the SA market. You just get the feeling people are reluctant to commit.
Graham Kerner at the Kerner Perspective. Thanks very much indeed. Do appreciate it.
The Money Show
with Stephen Grootes.
Well, I'm still intrigued to know what kind of car you realistically would like to buy. I'm not talking about the car that you wanted when you were 18. I'm not talking about the car you've always wanted. I'm talking about the kind of car that realistically you would buy. What brand? How fast? What? Would it be an SUV? Do you go camping? Kind of my thing. Have you decided that actually you're just going to buy a cheap bakkie because that's going to do it for your business? Are you looking at a sort of safe family car, whatever that is nowadays? A family car when your children are 3 is very different from a family car when your son is 16 and taller than you. Let me tell you all about it. So what kind of car would you realistically want to buy? There was a time when the car industry really spoke about sort of reliability, speed, kind of flair, passion, 0 to 0. Electric cars came and just wiped the floor with petrol cars when it came to some of that. But then people now want something different. I mean, I think for a lot of us, including myself, it is, does Android Auto and AirPlay work or not? Bluntly, that's all you want to know. That's become more important. And I was thinking about that today, and I'd like to know from you what you want to buy on 011 883 0702 and 021 446 0567, and why you want to buy it, because there was quite a lot of evidence today, or more evidence today, of some of the financial pain you might be feeling. Motus, they manage car dealerships, they sell parts, they provide other goods and services in the automotive chain. It says it's selling fewer new cars. It seems you're also trying to hang on to your car for as long as you can, so it is selling more parts. The company, reporting a drop in earnings, was able to increase its profit. It does mean that it still has made quite a substantial profit. That said, the share price down dramatically today, nearly 14%. Ockert Janse van Rensburg is the CEO of Motus. He took over late last year. Ockert, good evening. Clearly people are avoiding buying new cars where they can. What impact is that having on you? Clearly quite significant.
Hello, Stephen, and good evening to your listeners. Yes, we obviously want to sell as many as we can, and you're right. If the customer's not there, it's a bit harder. I think currently you look at the vehicle environment that we find ourselves in, and people have certainly started trading down quite a bit. I think in the last few years, you probably would have seen that. The trading down and going into more affordable vehicles has certainly been the way to go, and it probably was an impact of the economic circumstances we find ourselves in South Africa. But you see the same apply also in places like the UK, for instance. So it is certainly a world-renowned thing at the moment where people do trade down a little bit.
When people try and find a lower cost vehicle, what are they going for? Which is really a coded way of asking you. Are they buying more Chinese models?
So trading down is different meanings for different people. I think in your intro you just spoke about the fact that everyone these days I think will have all the bells and whistles already in those vehicles. I think there's very little to choose maybe sometimes between them. And brand reliability and what you get as a cost of ownership is becoming more important long term as well. So as much as a few people are looking at the short-term impact and just purely buying it on price, as you just mentioned, you could see suddenly quite a few new Chinese entrants, for instance, into the market, and they're really selling on price on day one. I think over time it does become more important for a customer to look at the long-term viability of the brand that they support, and making sure that there's enough workshops and parts, etc., also available. We certainly have seen one or two of those Chinese brands now making it into the market. You think the brands like Chery and Volvo and Suzuki, for instance, who are all fairly new to the market with the new offerings. They obviously will be making it. But some of the new entrants we will still have to wait and see, which makes it very difficult, obviously, if you need to decide which brands you're going to have inside our dealership network. We sit with over 300 dealerships. And we have now also introduced, obviously, a few of these new entrants, the likes of 8 different Chinese brands in them as well. And we will wait and see which ones are going to make it long term.
Part of this is that having a parts business, being able to have your car fixed sort of in any of the big cities or any of the big towns where you may live or where you may be when something goes wrong, that costs money. I mean, that's one of the reasons why some cars cost more than others. They have bigger networks. They have you can get more parts in more places. I would presume that your parts business may have a bit of a competitive advantage here, but it's not a big part of your business.
So the parts side of our business is actually situated in more than one area if you look at our financials in those segments. So while a vehicle is still under warranty, we reflect all those sales as part of the retail and even through the importers. And that would be parts that's under warranty, which normally last up to a 5-year period, or in the case of Hyundai, maybe 7 years. Our aftermarket parts side, which you just referred to, is actually that part of the business to service your vehicle that's older. So it's as soon as it goes pretty much out of warranty, up to, call it 15 years. And that side of the business was probably quite underserved in the past. I think a lot of our initiatives around it was to try and make sure we serve that part of the value chain a bit better. And we've certainly invested quite heavily into that area of the business over the last few years. We believe there's a lot of margin, obviously, on those parts. And yes, customers do drive the vehicles for longer. They seem to last longer these days as well. If you look at the average age of vehicles, they've all increased. The overall park has increased probably by 1.5 years on average over the last few years. And that's the part of the side of the business that we believe there's still a lot of road to run and a nice growth opportunity for us. It's not just in South Africa, it's also in places like the UK and Eastern Europe that we've been entering that market.
You mentioned in your SENS release today there was quite a lot of optimism in South Africa last year. You would think that would lead to higher car sales, especially with interest rates beginning to come down. I worry that some of that optimism has faded a bit and that consumer sentiment may actually not be as optimistic as it was, particularly in light of what we're seeing internationally, I suppose, executive order after executive order, but also because here, the tension over the budget.
Yes, I think it's difficult to call it. We will see exactly what happened in February. I think that positive momentum was still there, certainly in January. February, I think, there was a little bit of talk about it, but I think a big factor there is still the lower interest rates, which obviously is sitting with us. And a lot of consumers were sitting on the fence for a number of years and not getting into a replacement cycle. And we're waiting for a little bit of good news to really get back into it. So we hope that that positive sentiment do still remain. Obviously, what happens in the world, and sometimes, I don't know, South Africans have a way of maybe sometimes being slightly more resilient about that as well. So I think we'll manage it as we see fit. At the moment, there wasn't real indications of that yet up to February.
You've been CEO, I think it's 3 months now. A slightly tough time to take over, also taking over from someone who had been in the job for quite a while. How have you found it so far?
Yeah, it's obviously very challenging. I think it's always nice if you can take over and everything is just going your way. I think in our particular case, there's a lot of strategic thinking behind how we need to take this business forward. I think we're currently asking some difficult questions in some of our businesses and making sure that we're on the right track. And just testing it against the real fact pattern and forget about the perceptions. But certainly very exciting, and I think it's been pretty much a seamless transition as Osman moved out and I moved in, and we did get a new CFO, but hardly anything really changed in the process. So I think the whole succession plan was really well managed by the board, and we're confident going forward with the team that we've got.
Okay, thank you very much indeed. Ockert Janse van Rensburg, the CEO at Motus on The Money Show.
You're listening to The Money Show with Stephen Grootes, brought to you by Absa Corporate and Investment Banking, reimagining inclusive and sustainable economic growth at Beyond the Budget 2025.
Good to hear from you this evening. I know the rain's having a bit of an impact, but some positive spin-offs. The Vaal Dam looking very, very good at the moment, over 80%. And, of course, looks like we'll have a strong maize harvest as well. You'll hear about the Competition Commission from time to time. And my presumption has always been the Competition Commission really deals with relationships between companies. In other words, are they merging? Is there going to be an impact in some way? Is one buying another? Is there a takeover? It turns out under what I suppose may be draft guidelines, the Competition Commission may also have some jurisdiction on the internal restructuring of a company. Let's find out. Ntobeko Rapoleng is a senior associate in competition law at Cliff Decker Hofmeyr. Ntobeko, good evening. I understand there's sort of some new guidelines from the Competition Commission, but what jurisdiction does the Competition Commission have on the internal arrangements or the internal restructuring of one company?
Hi, Stephen. Thank you for having me. So getting straight into it, the Competition Commission has general jurisdiction of transactions that have an effect in South Africa. So generally speaking, any transaction that might affect market structure in a particular relevant market, the competition would have jurisdiction over. It just so happens, though, that with internal transactions, the convention is usually that those transactions would not have would not change the structure of any market, and usually by convention, the transaction would not really consider those as part of the jurisdiction, or more accurately, transactions that are in their purview to consider. However, the guidelines sort of provide now clarity of situations where there may be internal restructuring transactions that the Commission may deem worthy of being considered because they result in particular changes.
Okay, I hear the phrase transaction and I immediately presume it's between two entities, but this would be inside one entity. So would they still have jurisdiction then?
Yeah, that's correct. You may have an entity with multiple different firms. So a typical example of an internal restructure would be Company A, which is a parent company, and it would have two wholly owned subsidiaries, being B and C, and then it would decide for whatever reason to transfer its shareholding in B to C. In that situation, you still have a transaction between two different distinct firms, but they are still within one same group.
Okay. So the Competition Commission could, in theory, tell a business it cannot restructure in a particular way.
It's more accurate to say that the Commission would have the right to consider how that transaction would affect the market. So telling them no, I guess it's a possibility within their jurisdiction, but it's sort of at the end of the game, more likely would be a consideration of looking at how that transaction would affect the market and then making a decision from there.
Has it happened before? Has it happened often? I can't recall a case.
Well, internal restructures have been considered before, but per my knowledge, I don't know of many that have been prohibited. Actually, I don't know of any that have been prohibited because generally they don't have an impact on the structure of a market and they don't affect competition in any way.
Okay. There seem to be draft guidelines that are out. Would that change the situation dramatically? Does this mark a significant shift in how the Competition Commission is interpreting the law?
Well, it's not a complete overhaul in that some aspects of the guidelines are in line with the conventions that practitioners already apply now, and that's welcome clarification and confirmation from the Commission. But there are some implications of the guidelines that may change things slightly. So, for instance, the guidelines now seem to suggest that where a minority shareholder in a company, where there's an internal transaction that normally would be by convention deemed to not be notifiable, but in this particular situation, the guidelines say that where that transaction involves a change in the minority rights, regardless of the fact that the ultimate controller of the company will still be the same, the fact that the minority rights of a particular shareholder are affected may deem that transaction is notifiable. That obviously has implications for companies when they consider how they structure their companies, particularly in relation to minority shareholders who may not be part of the group, may just have control rights or particular veto rights in a company or two within the group. But because now this internal transaction would affect their rights, the guidelines as it stands deem that those transactions may be notifiable.
There are other questions, I suppose, about when a company has to tell the Competition Commission it's doing something to itself. I must say, if I were a company and I was having a restructuring, I don't know if I'd feel that I had to bother the Competition Commission with that.
Well, I suppose this is a good point for me to note that the Competition Act, as it stands, does note that a company cannot interact with itself. So if a company in and of itself, or if companies that are considered to be a single economic entity are dealing with themselves, that in and of itself, so for instance, shifts in the management of a company would not be notifiable. But when we are talking about distinct firms, even if they fall under the same group of companies, that could still be in the purview of the competition authorities.
Ntobeko, okay, it's fascinating. Thank you very much indeed. I'm really interested in how this pans out. Ntobeko Rapoleng is a senior associate in competition law at Cliff Decker Hoffmeyer. Okay, well, imagine there might be some pushback on that. The Competition Commission from time to time has made decisions that have been controversial. We'll see. 011 883 0702 021 446 0567. Your view on whether the Competition Commission should have jurisdiction on the internal restructuring of a company. We'll talk NVIDIA in just a moment. It's been at least a day since we last mentioned NVIDIA on this program. Also around succession planning in companies, and then understanding the power of the annual general meeting for your paddle club and your business in investment school this evening. You're with The Money Show. It's just gone 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
8 minutes after 7. Good evening. Welcome to the second hour of the program. The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, proud host of the Beyond the Budget 2025 event themed around reimagining inclusive and sustainable economic growth. Well, plenty to come in the next hour. Lots to look at. We'll talk about NVIDIA in just a moment. I don't know, and it's fascinating to me to just watch what happens around AGMs. On one level, there's the sort of drama. I don't know if you've seen Succession, what can happen around them. The idea that, a company can have some sort of dramatic change because of a decision taken at an AGM. Barloworld had their AGM yesterday, and they, of course, shareholders there had to consider that deal brought by the Zahed Consortium. The sort of element of drama came from the fact that Dominic Sewela, the CEO at Barloworld, was a member of that consortium, and in the end, shareholders didn't go for it. I think it was around 36% of shareholders voted in favour. The vast majority did not, and that's the end of it. And there's a sort of added drama of the fact that, in fact, come on, Stephen, that what happened is that shareholders also voted against the remuneration for independent board members, which seemed to suggest, in fact, they didn't like the board members and their decisions particularly much. But that's not what AGMs are normally like. They're normally quick, 20, 25 minutes, sort of, vote yes, this, that, virtually, etc., and nothing really happens. And so it's interesting to me to get to the nuts and bolts of it. That'll be your focus on investment school this evening, looking at succession planning in smaller firms as well. And so often a smaller firm is it kind of is its founder, right? It is the person who started it. If that person is no longer around, for whatever reason, they go somewhere else perhaps, then what happens to the company? That's one of the reasons it's so important. Good to hear from you this evening on 011 883 0702 021 446 0567 and voice notes tonight on 072 702 1702.
702. Stephen is on The Money Show.
6 to 8 p.m.
How many times have you heard a business report which includes the phrase NVIDIA? And that's because they make the microchips that are used or were used to train artificial intelligence models. And as a result of that, they're seen as a kind of dipstick for the direction of AI. They reported an 80% revenue jump this year. That was last night. There's not much competition in this space, but also because DeepSeek does not require so much training for its models, that's the presumption might lead to less demand for these microchips. It's not entirely as simple as that. Siphumelelo Zondi has been looking at this. He's our tech expert. We speak to him on a Thursday. Siphumelelo, good evening. You're going to have to stop me at the beginning of this. Whenever I think of artificial intelligence, I used to think of ChatGPT, then I think of that, I think of this. But I don't really think of microchips. Why are the NVIDIA microchips so special?
Well, the thing is, hello, Stephen, so let's start there, in fact. So the microchips are important because they basically are, you can call them the brain that stores all the functions of the technologies that we use and technologies that we don't use, technologies that are being tested. And that's why they're important. And what NVIDIA makes is actually quite important because they can determine the kind of complexities, or they're important for the complexities of artificial intelligence. You may think about self-driving cars, for example. The normal microchip that makes a computer run or that makes a smartphone run wouldn't be sufficient for a self-driving vehicle, for example, which needs to remember all the information that's stored in it, where it's going, where it's supposed to turn, and in order for it to eventually park itself where it's supposed to go. And all the different, you spoke about generative AI, for example, earlier, but that's not the only AI there is. There's all kinds of AI, especially as we go into the future, and the data centers that are needed for all this AI to store their information. That's what microchips are needed for, or these kind of microchips that store big chunks of information that NVIDIA makes.
Okay, so why is DeepSeek so important to this? Is this the famous claim that it only took $6 million to train?
And also the fact that they say they could make it run without NVIDIA microchips. They could make it run with much cheaper microchips. And so that's why it's important, because all along there was this belief that you need these fancy microchips and the technology that's quite expensive in order for artificial intelligence, especially generative AI tools to run. And then DeepSeek comes along. The United States of America has said to NVIDIA, hold on, you're not exporting anything to China, even though there are still question marks on whether they listened to the government of the United States or whether they bypassed them and found other means to send these microchips to China. But that's why it's a game changer, because the belief is that the microchips that they used for their generative AI tool are not NVIDIA, and they are microchips that are much cheaper, therefore, than this chip that everybody thought was crucial and essential for these generative AI tools to run is actually probably not as crucial as everybody thought it was. There are other alternatives.
I mean, it would completely change the game. There are other things that could happen too. I mean, it doesn't seem that NVIDIA faces any serious competition. Why not?
It hasn't. There have been other potential competitors, and that's partly why, for example, there were issues with Huawei in the United States of America, their development of their AI tools, their development of their 5G tools, and their possible development of the Ascend microchip that they said they were developing, and that caused some of the problems because they were then going to create competition for what I suppose American leaders feel is an industry that should be controlled by the United States of America and not be controlled or have competitors from elsewhere. But what seems to have come up now is that Huawei has said that they are resuscitating their development of their Ascend microchips, which are believed to be also another game changer that's probably going to be a competitor to NVIDIA, which comes from the United States of America. So that's going to be interesting on as they resuscitate something that they stopped when they were blocked from accessing certain technologies from the United States and other parts of the world. It's going to be interesting how much of a competition they're going to be in future going forward to NVIDIA that has dominated the market for the last couple of years.
It's surely not good for the development of artificial intelligence to have one firm that's so dominant. You would really want microchip competition. I mean, the microchips could themselves determine how AI does over the longer term. I mean, it could be very important, in fact, to have more than one at least.
Oh, totally, because you might think back to not just generative AI, to during COVID, for example, when we started to have a shortage of the shipment of microchips, and almost just about every piece of technology and the shipment of that technology, including the vehicles that we drive, started to slow down because there was that slowdown of microchips, largely because of the COVID lockdowns then, and not necessarily because of anything else. And we're not talking about these kind of microchips that are needed for future technologies that is largely being tested at the moment for it to launch in future. So if you have a concentration of something that is so crucial to the running of a technology that is so important for our future development as the world, and it's controlled by just one company. Should anything happen to that one company, you and I, Stephen, have spoken, for example, about companies getting hacked in the past. What should happen should that happen to NVIDIA, for example? What should happen should anything really happen to NVIDIA and suddenly they can't distribute this as much as they could? And also as demand grows with more companies launching more data centers because of a need of the data that we use, the data that's used elsewhere that needs to be stored somewhere. As that demand grows, if you have a reliance on just one particular developer of this tool, then you might run into a problem in the future, yes.
So to try and catch up to NVIDIA now would be very, very expensive. I mean, just look at their share price. You can see what investors themselves think. That said, nothing lasts forever, particularly in this industry, and AI could simply go in another direction.
Well, the other direction could be whatever DeepSeek has done out in China. Eventually, when they reveal to the world what it is that they did, or when the world figures out what it is that they did, that could enable them to develop their generative AI tool for much cheaper and perhaps maybe get into whatever they have. For example, there's Acelert, so that's Amazon. Yes, at the moment they say it's for quantum computing, those microchips from Acelert, but as more companies are actually developing, there is a possibility that monopoly is likely going to be broken in future. In fact, there is a belief that there might be a slowdown in the first quarter of 2025 for NVIDIA, even though NVIDIA says for them, they predict that they're going to do much better than the slowdown that's predicted, because they're predicting a forecast of $43 billion for the first quarter of 2025. But everybody else seems to believe that because investors started to worry when DeepSeek came out and they started to pull out slightly from NVIDIA, there is a belief that there will be a slowdown that might happen this year even, and as early as the first quarter of 2025.
Sure. Siphumelele Zondi, thank you very much indeed, our tech expert. All right, finally, understanding exactly what is going on in that world. 19 minutes after 7.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
Small Business Focus is brought to you by Capitec. No matter the size of your business, Capitec's got you. One of the things that can happen in a small business is it's often all about the person who founds it, right? Something can happen to that person, they can move on, they can pass on. Then that can be very difficult for the small business because it's the vision of the founder and no one else. The way around this is a succession plan, which can be quite difficult for a smaller firm. Luncedo Mtwentwe is the Managing Director, Advantage Advisory. Luncedo, good evening. Thanks so much for your time tonight. I mean, a succession plan can be easy. It can be difficult. It can be a whole series if you want. But for a smaller firm, how do you create a succession plan?
Yeah. Good evening, Stephen. Thank you for having me. Succession planning, as we know it, most of the time, as you have alluded, is usually discussed in big boardrooms. It's usually discussed in your JSE-listed entities, where, of course, the board of directors would typically oversee that process in terms of should there be any departure in one of the critical roles, either the CEO or some of the senior managers. At least there is a plan in place. At least it is a contingency plan that will be triggered or that will be put in place. And of course, it really makes sense for them because you have all the committees in place. You've got the board of directors, you've got audit and risk committee, you've got the CEO. So it makes perfect sense, really, just for the continuity of the business. However, now you bring it closer to an entrepreneur at an SME level, it becomes a different ballgame altogether because, one, you will notice that most of the entrepreneurs, they become everything in a business. They will become the CEO, they will become the HR manager, they will become the finance manager, they become everything altogether. And that, of course, that vacuum, it creates a situation where either the business then is not well allowed to grow because there is no one who's sitting at a vantage point to see how things are moving. Then it becomes all of that now where the CEO, should anything happen to the CEO at an SME level, then that's where the risk really kicks in because he is the only one who knows everything. He has not yet led the process or handed over or delegated or even trained people to know certain tasks because one would keep all of these things to themselves in the name of, I know how to do this. I'm the one who can structure this. And that becomes a danger at an SME level. So it's very important, one, for an entrepreneur to say, look, when I start my business, can this run itself without me in the next 3 or either 5 years? Or sometimes it takes time, of course. It can take you 10 years to be able to realize that.
The problem might be that it's just because it's a smaller business, just have a much smaller group of people to actually choose from. I mean, there just may be no obvious successor or group of successors?
Now, that is very important. And I think, what is important about succession planning is that it's really for for critical roles, right? And therefore, the moment you are the entrepreneur and the team that you are leading, then when you look at them and you see that there's no one who can be able to drive either a particular department or to lead either particular people, then that is a problem. Then that talks to you now as an entrepreneur. Either it is how you have recruited, because the plan and the direction and how you have to run a successful business is that it's not about you only. You have to have people that can be able to make decisions without you, people that can be able to grow your company without you. But the moment when you look within and you realize that there is no one who can do this, then you have to look introspectively in terms of what is your recruitment process, because that's where you have to say, how do I attract the top performers? Now, the moment you don't have the top performers then in your company, then you have a bigger problem.
Do you have to manage it financially as well? You have to know that certain things will happen. You have to know that whoever takes over from you really understands the financial situation of the company, because that's another problem. If there's a shock, not everyone's going to understand what's been going on.
Yeah. Now, that is where as well, as an entrepreneur, it's important for you that this is a business. It's not your personal life. You will not keep everything secret. The numbers, the employees will know. At the end of the day, you will get to a point where even you have HR, they will know everything about the numbers. Now, succession planning is really about creating or allowing certain employees to really rotate in different roles, especially once you have identified certain key employees that can be of future benefit for your business. Then rotation thereof to ensure that one well understands the operations, one well understands how we market this company on external stakeholders. One also understands in terms of how do we allocate our resources as a business? How do we plan our financial resources as a business? So it's not only keeping one in one particular position, especially if you have those potential leaders, you allow them to be well versed in terms of operations. So that's what life is about. That it's not about doing one thing all the time. Human beings, sometimes they get bored. So you have to stretch some of your particular employees to say, okay, you are good in this particular department. How about we put you? How about we stretch you further?
Sure.
You know what you're trying to do so that the dots can connect in the long run.
Lonqedo, thank you. Lonqedo Mtwentwe, Managing Director, Advantage Advisory.
702. Stephen is on X.
At Stephen Grootes.
I don't know if you've ever attended an AGM. It doesn't necessarily have to be a company AGM. Maybe it was your paddle club or something. I find that AGMs are often won by the people who turn up, to misquote Hillary Clinton. But I sometimes think that, it's interesting to see how powerful they can be. Well, we'll focus on that in just a moment, especially in light, and it's just an interesting case study, the Barlow World Extraordinary General Meeting yesterday, which voted against the deal to sort of delist and to be owned by a consortium. But it's a reminder of how powerful AGMs can be. Of course, shareholders, unfortunately, often don't exercise their rights. We'll discuss that too in a moment.
The Money Show.
Investment School.
The Investment School is brought to you by CFI, a leading global trading platform now available in South Africa. CFI Financial is an authorized financial services provider. Well, today on Investment School, we're talking about the annual general meeting. It's a key moment in any company. And as we saw through events this week, they can really determine the future of a company. They can make big decisions. It's shareholders talking to the board. It is also, in a way, a chance to understand what shareholders think about how a company is being run. Hlelo Giyose is Chief Investment Officer and Principal at First Avenue Investment Management, and Tracey Davies is from Just Share. a company which I suppose spends an awful lot of time going to AGMs and working out what strategies to follow. Hlelo, Tracey, good evening. Thank you both so much for your time. Hlelo, if I may start with you, I presume there is a legal definition of an AGM.
Hey, Stephen, pleasure to be on the show with you today again. There is a legal definition, but as you know, AGM stands for Annual General Meeting. Legally, it is a meeting in which management of the company has to communicate officially through official lines, legally recognized lines with shareholders, to tell shareholders or to report really back to shareholders on certain matters of how the business is running, but also to ask for permission on other matters. So it is a report back format that is legally required and binds management to return to owners of the company, that is owners who are people who own shares in a company, to communicate back and forth with them and receive permission on certain matters. And it's a whole range of matters, but that is the legal definition of an annual general meeting. It's a communication forum.
Tracey, who controls it? Because I know from experience, having as a journalist, having watched meetings, not AGMs, but all sorts of meetings, whoever controls it can often control the outcome. I presume there are quite strict rules to make sure that certain things by law have to happen.
There are, Stephen, and good evening. And this is a very different question depending on whether you have an in-person AGM, which is a very old-fashioned thing nowadays, or a virtual AGM, or an electronic-only AGM, as they're called, or a hybrid meeting where you can attend in person and also attend the AGM online, virtually. And you know, for the most part, the board, and particularly the chair of the board, controls the agenda and controls the pace and controls the content of the AGM. That has become quite a big problem in the era of hybrid and electronic AGMs, because it's much easier to shut people down, virtually. For example, you could mute me right now on this Zoom call. If we were in a room together, it would be much harder for you to shut me up. So the electronic AGM has introduced a whole bunch of new dynamics. But in general, and for the most part, it is the board and the chair of the board who controls the structure and pace of the meeting. The outcome, of course, is determined by the votes, the way shareholders vote on the resolutions. And they're also often, those votes have been submitted by, for the most part, asset managers long in advance of the meeting. This is something else that we think is an unfortunate development, because it means that often by the time the meeting happens, management and the board is already aware of what the outcome of the vote will be. And that often plays a big role in how they conduct the meeting.
Hlelo, AGMs have been held for a very long time. Are they, obviously, for example, during the pandemic, they changed and became more virtual. But are they still serving the same purpose despite everything that's changed? Obviously, on one level they are. It's shareholders basically having a say kind of annually on what the board is doing.
They have an incredible purpose, an indispensable purpose. And here's a reason why. Management of a company often act like they own the company, but they are not owners of the company. And you could treat them as owners. You could make the mistake of thinking they're owners, because they come up with these ideas, suggestions that they put to, at the board, that they put to shareholders. But actually, the entire activity that management undertakes, it undertakes it as an agent. And shareholders are principals. And so there is something called an agent-principal relationship, which from time to time has conflicts. And you've seen recently at Baller World, it's a recent example in South Africa where you've had an incredible conflict between the agents, management, and the principal shareholders. And the board is supposed to moderate that that relationship, to smooth out, to remove cognitive dissonance to that relationship. And when a board fails to do that, the principal, who is the owner of the company, has a duty to correct the problem. And the problem could be you remove management, but it could be you remove the board too. So it is extremely important. Without it, then management become principals and agents.
Tracey, how difficult is it for shareholders to actually have that say? And I mean, the Barlow World thing is interesting, and it can be difficult in that it's not like people can necessarily stand up and say, this is what I think of the board decision. They have to do it through another way. So, for example, as I understand it, what happened earlier this week is shareholders voted against the remuneration policy for independent directors. It's not the first time that that's happened, but that seemed to me to be sending quite a strong signal.
Yes, it is sending a strong signal, and it is the most powerful signal that shareholders can send to a company. And it's a very public signal, right? Because everybody can see what that vote was. I completely agree with Hlelo. There are many instances, if not most instances, where management confuses its role and thinks of itself or behaves as if it is the owner of the company. And unfortunately, I think that in the South African context, its owners often sort of capitulate to that view. They allow that to be the sense that, they allow management to have the sense that they are the owners of the company. And so what happened at Barlow World is extremely rare, in the sense that you have a majority of shareholders coming together, not necessarily by any coordinated means, but obviously they all have the same view, and voting against a particular proposal or more than one proposal, or the appointment of a director on the basis, obviously, that they don't think that that is the right move for the company at the time. But the AGM is such a crucial moment precisely because of that opportunity for a public statement, not just a public statement by shareholders, but also a public accounting by management of how they have been managing the company and what the results have been and what the future looks like. And so, at Just Share, one of our kind of perpetual laments is that the AGM is so underutilized in the South African context. So few asset managers go to AGM, vanishingly few asset owners go to AGMs. And the reason for that is that over time, we have developed a system whereby management has private meetings with shareholders, big shareholders, and they come to compromises and agreements behind closed doors, and often there are very close relationships between those individuals. And that makes it very difficult to hold people accountable when things go wrong. And so AGMs are a really good place for shareholders to see how management performs under pressure, how they answer difficult questions from challenging activists, for example, like ourselves, and how they engage with stakeholders. So it is really a great pity that the potential of the AGM is so underutilized by South African institutional investors.
Hlelo, would you agree with that? I mean, is it wrong that some big shareholders get sort of preferential treatment, and that you can have a situation where they can kind of make a decision, make sure the AGM comes to a predetermined outcome? It seems pretty easy to do, and yet you can see it. I mean, even in the Barlow World, you could sort of see the way the two votes went on the takeover and on the remuneration. If I remember correctly, the numbers were the same.
But, I think Tracey is right in the sense that it's like what you're seeing in the White House now, where Donald Trump is governed by executive order. If you make a habit of doing what Tracey says, if management makes a habit, that is, of, having sidebars at all times, or if they abuse that practice, going to large shareholders on most issues, and getting approval and cutting a deal there, and only showing up at the AGM with a resolution already passed. If that's how management chooses to quote unquote govern the country or govern the company, very soon I think it's going to be found out. And from a governance standpoint, that will start to reflect on their reputation. Investors will account for that in their perspective of the quality of ESG or governance in that company, because that would mean that the potential for any shareholder to have to hold an independent view and execute it and see it through is minimized. So eventually, that's going to reflect in hopefully the share price of that company not performing as well.
So, okay, if shareholders, Tracey, are really angry, I mean furious, apart from voting against remuneration, is there anything they can do? They don't get to remove the board, do they? Unless there's a motion. How does all of that work? If 100% of shareholders hate the board, how would they go around getting rid of the board?
Well, remuneration votes, of course, are not the only votes that are put to shareholders at AGMs. At every AGM, there will be at least a portion of the board up for re-election because they have 3-year terms, or somebody might be stepping down, or somebody might have just been appointed. So every AGM will have an opportunity for voting for or against certain members of the board. Another argument that we frequently make at Just Share is that is, in fact, far more powerful than a remuneration vote as a sign of shareholder discontent, is making a statement by voting against a particular director or the directors who are up for re-election. Of course, shareholders can't directly vote for the appointment of a CEO or a CFO, so it's a kind of indirect way of illustrating that you are not happy with the way the company is being run or managed, or the way the board is conducting itself in a particular way. So, every AGM, there will be many 10, 15, 20 resolutions on the ballot, and each of those resolutions is its own little mechanism for indicating support for the board and the company, or opposition to the board and the company. And again, we have heard over and over again from institutional investors in South Africa when we have these conversations with them, oh, no, we could never vote against X person or Mr. Y or Mr. X because, it's not their fault. I mean, the board operates as a whole, or management is, very dominant. So there's there's a strong reluctance in South Africa among the South African asset management. Not everybody, there are exceptions, but overall, there's a very strong reluctance to vote against directors. I mean, you can take the voting results of any AGM at random, and it will be extremely rare to see a director who has received less than 98% of shareholder votes in support. And this is even when companies are in dire straits. So there is a reluctance to do that. There's also, as I say, personal relationships behind the scenes. Also, remember, many of our institutional investors are themselves listed companies, which I mean is a really potentially big conflict of interest, because you as the asset manager don't want to be someone kicking up a fuss at an AGM in case someone comes and does that at your AGM, right? And then, of course, the strongest tool is that South African law is very clear that shareholders can themselves propose resolutions at AGMs. And thus far, Just Share is the only shareholder in the country who has ever tried that on an ongoing basis. And we have been repeatedly blocked by companies like Sasol and Standard Bank, who insist that we don't have the right to do that because it is undue interference in the management of the company. This is really just a legal filibuster to avoid having to table the vote. And it's something that will require resolution in a court at some point. But I guess my overarching point is that shareholders have enormous power and they choose not to exercise it.
Tracey Davies from Just Share, Hlelo Giyose, Chief Investment Officer at First Avenue Investment Management, our guests on Investment School tonight. Our topic, the AGM. Investment School tonight, Tracey Davies from Just Share, Hlelo Giyose from First Avenue Investment Management, your guests on Investment School, all around AGMs. Hlelo, when the AGM starts, is there a duty on the board to make sure that the information given to shareholders is entirely accurate? I mean, obviously there must be, but is there an information disadvantage for shareholders?
No, there is none. I mean, the company is responsible, and here I think it's management is responsible to provide the information that the board ratifies and vouches to be true to shareholders. By the way, Stephen, I just want to go back to one of the points we talked about earlier. I think at Bala World, the vote was also not only to reject directors' remuneration, but it was also to reject re-election on some of the directors. I think it was closer to about 42, 43%. So that is very rare, by the way.
It's quite something that all of this has happened, and yet I'm kind of struck, Hlelo, by Tracey's point that it hardly ever happens. Do you agree that the culture of AGMs is just to kind of go along with it? Because that's certainly how it sounds.
Yeah, it is. And I was thinking about this, that, one of the problems, obviously, in South Africa versus maybe more deeper capital markets is that the vast majority of shares in companies in the stock market are owned by fewer and fewer large asset managers. So, the Coronations of this world, the M&Gs of this world, the Old Mutual, Sanlams, Ellen Gray, they probably own about 70% of all assets under management in South Africa. So the concentration of ownership probably, what that does is that it discourages smaller managers from having a big enough voice at an AGM. So if you show up in your First Avenue and you own 0.01% of Anglo American and you have a really good point, and Anglo American says, well, how much do you own? You say 0.01%. You know what? You can go jump. But if you show up as Alan Gray and you own 10%, well, everybody sits up and listens. I think that probably has something to do with it.
Tabo on the line from Ramsig. Tabo, your question for Hlelo and Tracey. Quickly, if you can, please, go for it.
Yeah, I just want to find out how rising in South Africa is the usage of your N shares, your B shares, because those shares usually have got more controlling rights than any other shares. Is it rife in South Africa to entrench control? How rife is it?
That's a great question, Tabo. Tracey, Tracey, I don't know if you're able to answer that for us.
Stephen, I'm sorry, I didn't quite hear the question. Was it about entrenching control with different classes of shares?
Yes, so you've got A shares and N, and I think they're called N shares.
Yes, and of course that is not the case with all companies, but in the cases where it is, where that is NASPAS, for example, every single institutional investor who owns shares in NASPAS could vote in a particular way, but because of the share structure, if the A shareholders vote against that, then they win. So, to some extent, that is an anomaly, and it makes shareholder influence over a company a lot weaker. And I think you see that with a company like NASPAS; it doesn't really respond to shareholder pressure.
It's fascinating. Hlelo, are you expecting the culture of AGMs to change? Could Bala World be a turning point?
I really hope it is a turning point, especially because of how egregious the situation in Bala World is. And I hope someone actually writes a paper on that, publishes it, and the Institute of Directors should use that to train future directors about the complete lapse in judgment and miscarriage of corporate governance responsibility and fiduciary responsibility. I really do hope so.
Thank you very much indeed. Hlelo Giyose, Chief Investment Officer Principal at First Avenue Investment Management. Tracey Davies is Executive Director at Just Share on Investment School this evening.